Today we're diving into one of the most important topics for anyone looking to buy a home, mortgage basics and how to qualify for a loan. A mortgage is simply a loan you take out to buy a home, but how does it work? In today's discussion, you'll learn the different types of mortgages available, and most importantly, learn how to qualify for them. Thanks for watching. So let's start by breaking down the different types of mortgages you might encounter when shopping for a home. From conventional loans to FHA loans, VA loans, and more, today's discussion is meant to help you understand the pros and cons of each and which one might be the best fit for you. Getting approved for a mortgage isn't as simple as just picking a type and filling out an application. Lenders look at a variety of factors when deciding whether or not to lend you money, including your credit score, debt-to-income ratio, employment history, and more. So I'll explain what each of these means and how you can improve your chances of getting approved. And of course, one of the biggest questions you'll face when shopping for a mortgage is how much you can actually afford to borrow. So I'll provide some helpful tips and tricks for figuring out what your budget should be and what you should keep in mind as you shop for your dream home. So if you're feeling overwhelmed by the mortgage process or just looking to brush up on your knowledge, I promise you this discussion is for you. As a first-time home buyer, the idea of taking out a mortgage might seem daunting, but it doesn't have to be. A mortgage is a loan that you take out to buy a home, and it's secured by the property you're purchasing. You'll make regular payments to your lender over a set period of time until the loan is paid off in full. Mortgages can be a great option for those who want to own a home but can't afford to pay for it outright. They can also offer some advantages over other types of loans, such as lower interest rates and tax benefits. So how does a mortgage work? When you apply for a mortgage, your lender will look at a number of factors to determine if you qualify for the loan, such as your credit score, income, and debt-to-income ratio. Your lender will also consider the appraised value of the property you're looking to buy. If you're approved for a mortgage, you'll typically make a down payment of anywhere from 3% to 20% of a home's purchase price. Of course, this can vary depending on your individual circumstances. The higher your down payment, the lower your monthly mortgage payments will be. After you've made your down payment, you'll start making regular monthly payments to your lender. These payments will be divided into two parts, principal and interest. The principal is the amount of money you borrowed, while the interest is the cost of borrowing that money. Over time, as you make your monthly payments, you'll build equity in your home, which is the difference between the current value of the property and the amount you still owe on your mortgage. Once you've paid off your mortgage in full, you'll own your home outright. Until then, it's important to keep up with your monthly payments to avoid defaulting on your loan. Understanding how a mortgage works is an important first step in the home buying process. By doing your research and working with a reputable lender, you can make informed decisions about your mortgage and feel confident in your ability to become a homeowner. Now that you have an understanding of what a mortgage is and how it works, let's talk about the different types of mortgages available. First, there's a fixed rate mortgage. This is the most common type of mortgage where your interest rate stays the same for the entire duration of the loan, which is usually 15 or 30 years. This means your monthly payments stay the same too, providing predictability and stability. Next is an adjustable rate mortgage, also known as an ARM. This type of mortgage has an interest rate that can fluctuate over time, typically every year after an initial fixed period. This means that your monthly payments can change too, so it's important to be aware of the potential risks and benefits of this type of loan. Another type of mortgage is a government-backed loan, which includes FHA loans, VA loans, and USDA loans. These types of loans are insured by the government and often have more lenient qualifications, making them a great option for first-time homebuyers or those with lower credit scores. Finally, we have what's called jumbo loans, which are used for homes that exceed the conventional loan limit. These loans typically have higher interest rates and stricter qualifications, but they can be great options for those looking to purchase a higher-priced property.
Did you know the book Unlocking Doors for You is a must-read for investors who are looking to get a start in real estate? This comprehensive guide covers everything from financing to closing, providing practical tips for navigating the complex world of real estate. Plus, the book includes a special focus on no money down payment programs, so you can get started with confidence. With JJ's expert insights and easy-to-follow guidance, you'll be well on your way to unlocking doors and building your real estate portfolio. So why wait? Buy your copy on Amazon to start your journey towards success in real estate right now.
So I'd like to address a question that came through in the chat, which was, what is the difference between a NACA mortgage and the rest? So this is a great question. NACA, or the Neighborhood Assistance Corporation of America, offers a really unique mortgage program that is different from many traditional mortgage options. One of the biggest differences is that NACA does not consider your credit score as part of the qualification process. Instead, they use a more comprehensive approach to assess your ability to make mortgage payments. This approach considers your payment history, savings, and other factors to determine your ability to repay the loan. Another unique feature of NACA's program is that they offer below-market interest rates with no money down payment required. Plus, they provide counseling and support throughout the home buying process, including assistance with credit repair and budgeting. So there are a number of things to consider with NACA, but if you're looking for a mortgage with a lower interest rate and you want a no down payment requirement and you're willing to work with NACA to meet their unique criteria, then certainly a NACA mortgage might be a great fit for you. Qualifying for a mortgage is a crucial step in the home buying process, as you can imagine. Lenders use a variety of factors to determine whether you are eligible for a mortgage and how much you can afford to borrow. When you apply for a mortgage, your lender will evaluate your financial situation to determine how much money you can borrow. This process is known as qualifying for a mortgage. There are a few factors that lenders consider when determining your eligibility. One thing they consider is credit score. Your credit score is a measure of your credit worthiness and ranges from a score of 300 to a score of 850. The higher your credit score, the more likely you are to be approved for a mortgage. In general, a credit score of 620 or higher is considered good, but some lenders may require a higher score. Another factor that lenders consider when evaluating your mortgage application is your debt-to-income ratio, or what they call DTI. This is a measure of your monthly debt payments compared to your monthly income. Generally, lenders prefer a DTI of 43% or lower, but some lenders may be willing to go higher depending on other factors, such as your credit score. Lenders will also look at your employment history and income when evaluating your mortgage application. Generally, lenders prefer borrowers who have a stable employment history and steady income. If you're self-employed, you may need to provide additional documentation to prove your income. Finally, lenders will look at your assets, such as your savings and investments, when evaluating your mortgage application. This is because having a substantial amount of assets can make you a less risky applicant to lenders. To increase your chances of qualifying for a mortgage, it's important to maintain a good credit score, pay off any outstanding debts, and avoid making large purchases or opening new lines of credit during the loan application process. You can also work with a mortgage broker or lender to determine which types of loans you may be eligible for and what steps you can take to improve your chances of approval. Remember, qualifying for a mortgage is just the first step in the home buying process, so make sure to do your research, understand your options, and work with a trusted real estate agent to find the home of your dreams. So another question came through the chat, and that question is, what is a debt-to-income ratio, and how does it affect my ability to get a mortgage? So first things first, a debt-to-income ratio is a comparison of your monthly debt payments to your gross monthly income. Lenders use this ratio to determine your ability to repay your mortgage. Being able to calculate and understand your DTI is an important step in determining how much you can afford to borrow when applying for a mortgage. Generally, a debt-to-income ratio of 43% or lower is required to qualify for a mortgage. So here are a few things that you'll need to do. First, add up all of your monthly debt payments. This includes things like credit card payments, car payments, student loans, or any other monthly debt obligations you may have. Next, add up your monthly gross income. This is the total amount of money you make before taxes and deductions. Finally, divide your total monthly debt payments by your total monthly gross income. This will give you a decimal that you can convert to a percentage by multiplying by 100. So for example, if your total monthly debt payments are $1,000 and your monthly gross income is $5,000, your debt-to-income ratio is 20%. It's important to keep in mind that lenders typically want to see a debt-to-income ratio of no more than 43%. However, some lenders may have stricter requirements, so it's always a good idea to check with your lender to see what their specific requirements are.
Did you know that finding a home isn't just about buying a house? It's about finding a place where you can thrive and feel like you belong. That's why working with JJ Scheinwynn, a real estate agent who is passionate about housing equity, can make all the difference. He has years of experience helping people on their homeownership journeys, considering everyone's unique needs and lifestyles. So whether you're looking for a home in Southern California or anywhere in the country, he is there supporting you through his global network of eXp Realty agents. You can trust he will always go above and beyond to make sure you feel confident and comfortable throughout the home buying process. So if you're ready to find your dream home, call JJ Scheinwynn today.
When looking to buy a home, one of the biggest questions on your mind is probably, how much can I afford to borrow? This depends on several factors, of course, including your income, your debt, and your expenses. To start, you'll need to look at your income. Lenders typically want your total monthly housing payment, which includes your mortgage payment, property taxes, and insurance, to be no more than 28% to 36% of your gross monthly income. Your gross income is your income before taxes and other deductions. Next, you'll need to factor in your existing debt. Lenders also want your total debt, including your housing payment, car payments, credit card payments, and other loans, to be no more than 43% of your gross monthly income. This is called your debt-to-income ratio, or DTI. It's important to note that these are general guidelines, and different lenders may have different criteria. Additionally, if you have a high credit score and a good payment history, you may be able to borrow more. To get a more accurate estimate of how much you can afford to borrow, you can use an online mortgage calculator. This tool will take into account your income, debt, expenses, and other factors to give you an estimate of how much you can afford to borrow. It's also a really good idea to get pre-approved for a mortgage before you start looking at homes. This process involves submitting your financial information to a lender who will review your credit score, income, and other factors to determine how much they're willing to lend you. By getting approved, you'll have a better idea of how much you can afford to spend on a home, and you'll be in a better position and a stronger position to make an offer when you find the right one. Stay tuned for additional episodes of Unlocking Doors for You, with even more valuable insights and tips to help you achieve your real estate dreams. And don't forget to follow me on Instagram, TikTok, and YouTube at JJ Your Realtor for even more great home buying and interior design content tailored just for you. Thanks for listening.
Did you know the book Unlocking Doors for You is a must-read for investors who are looking to get a start in real estate? This comprehensive guide covers everything from financing to closing, providing practical tips for navigating the complex world of real estate. Plus, the book includes a special focus on no-money down payment programs, so you can get started with confidence. With JJ's expert insights and easy-to-follow guidance, you'll be well on your way to unlocking doors and building your real estate portfolio. So why wait? Buy your copy on Amazon to start your journey toward success in real estate right now.